And the economy collapsed and the stock market fell well over 50%, I think 60%. So that was an example of both. And what I'm concerned about, and again, this is to your point, is we may be heading into both. And if everything I said about what's behind the curtain, the plumbing of the financial system, acute dollar shortage, scramble for collateral, show the early warning signs of a global financial panic, and a likely recession. Again, we've had the 2 quarters, it could get worse. Even if third quarter is positive, maybe it could drop hard in the fourth quarter once we get into.
In today's video, James Rickards, former advisor to the Pentagon, the White House, Congress, the CIA, and the Department of Defense says, a financial crisis spreads just like a virus does. Jim is concerned we may be heading into a recession plus liquidity crisis, similar to what we experienced during the 2008 GFC. Before listening to him, please ensure to smash the like button and subscribe to the channel. Let's dive into his last interview now.
I almost always agree with his analysis and then disagree with his policy. So I always have to stop halfway with Larry Summers. Like, good analysis, Larry, but you're going the wrong way. But yeah, I think he's right that the dollar will get stronger, if that's even possible. I mean, of course it's possible, but it seems like it can't go on any longer, but I think it will. And I think the Bloomberg headline is probably correct also. Where I disagree, and this is critical, is the reason why. The dollar is getting stronger for some very bad reasons, meaning bad in terms of the macroeconomy, what probably lies ahead, what is probably telling us. So let's just maybe step back and not be Larry Summers for a minute, but just be everyday investors and asset allocators and analysts and say, and I hate to use the word conundrum because Greenspan used it, but conundrum is a fancy way of saying I don't really understand what's going on. But this is a conundrum for a lot of people because they look at it, the U.S. objectively, okay, our debt to GDP ratio is over 130%, highest in U.S. history. Tons of research coming from obviously Ken Rogoff, but really Carmen Reinhart, Vincent Reinhart, and others, but many others, not just them, that says at those debt to GDP ratios, you can't grow. You can maybe refinance and muddle through, but it always ends either in default, which is unlikely because we can print the money, that much is true, or extreme inflation where here's your $1 trillion back, good luck buying a loaf of bread. So we'll see how that plays out. But the way it's playing out in real time is that the U.S. economic growth is incredibly weak. So we've got sky high debt to GDP ratio. By the way, when you look at other countries in the world, you say, okay, who's at that lunch table, 130%? The answer is Lebanon, Greece, Italy. Those are your lunch partners, so to speak. And
this is like the scene from Animal House. Would you like to meet Clayton, Jagdash, and Muhammad?
that's a good comparison. Economic growth is weak. We're in a recession. I don't care what Janet Yellen says. I don't consider her expert on the topic, but we've had our 2 consecutive quarters of declining GDP. Like it or not, that's the definition of recession. The fact that the National Bureau of Economic Research, which is a private group, by the way, but they're the recognized referees on recessions and recoveries, the fact that they haven't said so doesn't mean anything because they never do say so until 9 months or a year after it happened. And for that matter, most recessions are 2 quarters, some 3, some have been longer, but most recessions are a couple of quarters. The National Bureau of Economic Research usually declares a recession after it's already over. Like it started, it happened, it's over, we're in recovery. And they go, oh, by the way, we had a recession last January. Okay, so they'll probably get back to us, I would bet heavily after the election. But we'll hear from them at some point. But we're in a recession now, and people say, what about the third quarter? And it's interesting because I do put some weight on the Atlanta Fed GDP now. I do think it's a very good tool. They miss sometimes, they're not always accurate, but it's the best tool out there. But very few people understand their statistical technique. Because what Wall Street does, you get a whole bunch of components for GDP, and they come in at different times with different lags, and you add them all up and you get GDP. And what Wall Street does, they look at what they have and they project all the rest based on regressions and correlations, which don't necessarily hold up. But here's what we think. Here's our forecast for third quarter GDP based on projections of what we don't know. Atlanta doesn't do that. Atlanta takes what we do know, hard data, and they ask a different question. They say, what would GDP be now if this was all we had? And they put out a number, but they don't guess at the stuff they don't have, and it fills in as it goes along. So it's much more Bayesian in that sense. But because of how the data comes out, the time sequence to which the data comes out, it typically fades as the quarter goes on. It's not because they're using bad methodology. It's just because that's how they do it. And so just in the last week, 9 days or so, it went, everyone was cheering. I think with September 1st, it was 2.3%, maybe a little higher, but about 2.3%. 2 days later, it was 1.6, and now it's down to 1.3. So it's following that pattern. I would expect by the end of September, we still got 3 weeks to go, given what I said about how it fades, it doesn't have to be negative, but it could very well be negative, maybe 3/4 of decline in GDP. But whatever it is, it's going to be weak. So if it's positive, 0.2 or 0.3, I mean, that's okay, but you're still a rounding error away from recession. It doesn't mean the problem's over. So debt to GDP sky high, economy weak at best, probably had a recession in the first half. Maybe that's continuing. People talk unemployment close to an all-time low, went up a little bit in the last report. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working, prime age 25 to 54 years old, who are not in the workforce. Yeah. That measure is picked up in labor force participation rate, which is low. I mean, that peaked around 70% in 2000, up from the 1970s, and that was women coming into the workforce and other factors. But now it's down to around 62% and change. It ticked up a little bit in the last report, but it's still extremely low. It's never 100. I mean, there's always, you could be a homemaker, a student, they're retired, early retirees. There are a lot of reasons people aren't in the workforce, but not taking 10% off or 14% decline from the starting place in over 20 years. That's so if you throw those people into they're not called unemployed because they're not looking for jobs, but if you threw them in, unemployment would be closer to 10%, which is a recession or a depression level, actually. So, and I could go on, but the point is there are all kinds of signs of weakness. So, I forgot the deficit, where, the baseline deficit is $1 trillion. That's before an extra $2 trillion for Trump's COVID relief, an extra $3 trillion for Biden's COVID relief, if you include the ludicrously named Inflation Reduction Act, right. and the American Rescue Act and the Infrastructure Act. Call it what you want. It's still $3 to $4 trillion. Two for Trump, that's $6 on top of $2 baseline. That's $8 trillion in 2 years. So your deficit's out of control and your trade deficit's out of control. So what's not to like? And you look at all that, you say, what, are you kidding me? I mean, get me out of the dollar. Go get anything else. Why is the dollar so strong? And the answer is, for this, you have to go behind the curtain. You have to look into what's called the plumbing of the international monetary system. But what happens if that money supply, now I'm talking about Eurodollars, actually shrank? And that is a heart attack in the global financial system. So now we're like, well, okay, what's going on? And believe it or not, there's a global dollar shortage. And when you say that, people say, wait a second, you kidding me? The Fed printed, the Fed's balance sheet in 2008 at the start of the global financial crisis was $800 billion. It was $4.5 trillion by the time we got to the end of the taper in November 2014. Then, okay, Yellen a little bit, but mostly Powell got it. They started quantitative tightening. They got it back down to around 3.5 trillion by the time COVID came along, and then boom, it's up to 7.5 trillion. Might have gone higher than that, and that's M0. M1 was exploding even more. So people go, so the Fed printed, $7.5 trillion. How could there be a dollar shortage? And that has a two-part answer. One is the money printing, at least M0, is irrelevant. It just doesn't matter, because how do they print the money? Well, the Fed buys securities from the primary dealers, and I was, after I left Citibank, I joined one of the biggest primary dealers, and I was there for 10 years, so I had a front row seat. But my point is, I was a counsel of a primary dealer. We talked to the Fed every day, and so the primary dealers are the ones where the Fed open market desk, the New York Fed does monetary policy. They buy, so they call up Goldman Sachs or Citi or whoever. So offer me, 5-year notes or 2-year notes or whatever. Here's a price done. The banks send the securities to the Fed, and the Fed pays for it with money that comes out of thin air. There's nothing more to it than that. But here's the part that matters. What do the banks do with that money? They give it back to the Fed in the form of excess reserves. It's the bank deposit at the Fed, in effect. So that money never went anywhere. It was created. It is on the balance sheet, but it all went to the asset side, which were securities, and it never went into the economy. So where does the money come from that runs the economy? It comes from the commercial banks. It comes from M1. Yeah, there is a multiplier, but that's in M1 and M2, which is created by the banks at will. And the Fed, those commercial banks have as much printing power as the Fed. They just do it differently by lending money or buying securities and paying for them with money that they create. So, and that never happened. It happened to some extent, but not nearly to the extent that what the Fed was doing with M0. So M0 didn't really matter. I mean, I hate to break it to people, but the Fed kind of doesn't matter. Commercial banks do matter. Eurodollars do matter. So everything I just described is playing out, and there's data to back it up. And we get into not just an inverted treasury yield curve, which is interesting, in the kind of 2s to 10s and 2s to 10s is the main sector where it's inverted. A really important distinction between a recession, even a bad one, let alone we've been in a depression since 2007, and a financial crisis, because they're two different things. They can come together. But for example, in 1998, we had an acute financial crisis, and with long-term capital management, and I negotiated that bailout. I had front row seat on that one. But 1994, the tequila crisis, and there was the bond market massacre. There have been these financial crises, but there was no recession in 1998. In fact, the NASDAQ went to, whatever, it went to the moon. We were looking, long-term capital, we were licking our wounds after the meltdown and, turning on CNBC and watching, pets.com, the sock puppet, and JDSU, and the guy with the beret, and all these things. They're going to the moon. I'm like, hey, we just got wiped out. But the opposite is true. You can have a recession without a financial panic. 1990, we had kind of a mild recession. There was no financial panic then. 2020 was interesting. I don't know what to call it. I mean, technically a recession, but the economy drops 31% annualized, and they say 2 quarters, first and second quarter of 2020, but it was really 2 months. I mean, if you break it down, it was March and April. They just happened to fall in 2 quarters and took both quarters negative, but it was really 2 months, down 31% and annualized in 2 months, and then up 35% by the third quarter. I mean, that was crazy. So maybe that's technically a recession, but that's just what happens when you shut down the economy. We don't need to be macroeconomists who say, hey, you close down the economy, that's what happens. But there was not a financial panic. Stock market fell, but the banks didn't fail. And nobody was worried about, nobody was lined up to take the money out of Citibank, et cetera. But sometimes so you can have recessions without panics. You can have panics without recessions. October 19th, 1987, Dow falls 22% in one day, no recession. But sometimes they do go together. In 2008, they did. We had both. We had an honest to goodness financial panic. Everyone knows, Bear Stearns, Fannie Mae, Freddie Mac, Lehman, AIG. But I can tell you, and I've spoken to a lot of people, Morgan Stanley was days away. If you had talked to John Mack, he's like, hey, I got no time to bail out Lehman. We're trying to keep afloat ourselves. And then Goldman would have been behind that, probably Citi, and maybe JP Morgan would have been the last one standing. And the economy collapsed and the stock market fell well over 50%, I think 60%. So that was an example of both. And what I'm concerned about, and again, this is to your point, is we may be heading into both. And if everything I said about what's behind the curtain, the plumbing of the financial system, acute dollar shortage, scramble for collateral, which leads to deleveraging, because if I can't get the collateral, I got to take the trade-off.
Yeah.
Leveraging of balance sheets, et cetera, which are the early warning signs of a global financial panic. And a likely recession. Again, we've had the 2 quarters. It could get worse. Even if third quarter is positive, maybe it could drop hard in the fourth quarter once we get into